Your business bank account is on every business credit checklist ever written. Open a dedicated account in your business name. That's it. One line and everybody moves on to the next item. So most business owners open something, check the box, and never think about it again. And then 2 years later, they apply for real funding and get turned down, and the bank account is a bigger part of that story than anyone told them. Because here's what nobody explains. That account is not a checkbox. It's a document. It's one of the primary things a lender reads when they're deciding whether to give you money, and how you've been using it says more about your business than almost anything else in your file. Let me start with what a lender actually does with it. When you apply for real financing, a bank line of credit, an SBA loan, revenue-based financing, most things above Tier 3, you are going to be asked for bank statements, usually 3 months, often 6, sometimes 12, and an underwriter is going to read them line by line looking for a specific set of things. First, they're looking at your average daily balance. Not your revenue, not what you deposited, what actually sat in the account day after day across the month, because that number tells them whether you can absorb a bad month. A business that deposits $50,000 and runs down to $200 by the 28th is a very different risk than a business that deposits $20,000 and holds $8,000 throughout. Second, they're looking at deposit consistency, regular deposits arriving on a predictable rhythm from identifiable sources. That reads as a business with real customers. Lumpy, irregular deposits with big gaps read as a business that may or may not still be operating. Third, they're counting negative days, any day the account went below zero. Overdrafts are one of the fastest ways to get declined, and most people have no idea an underwriter is literally counting them. Fourth, they're looking at whether other lenders are already taking money out. Daily or weekly debits to a merchant cash advance company are visible in your statements, and they tell an underwriter that your cash flow is already spoken for. And fifth, the one people never see coming, they're looking at whether this account even belongs to the business they're evaluating, which brings me to the part of this that connects directly to your credit file. Your business bank account has to be in your exact legal business name, not your name doing business as, not a shortened version, not your name with the LLC dropped because the bank's form field was too short. The name on that account needs to match your articles of organization, character for character, the same way your business credit file does. Because when a lender or a bureau is verifying that your business is real, they are cross-referencing sources. Your entity filing, your EIN registration, your credit file, your bank records. If 3 of those say one thing and your bank account says something slightly different, you've introduced a mismatch into a verification process that is largely automated and not built to give you the benefit of the doubt. I've said before that name mismatches are the most common quiet failure in business credit. The bank account is one of the places it happens most because banks let you nickname accounts, because online applications truncate long fields, and because a lot of people open the account before the entity paperwork is fully finalized and never go back to correct it. One more thing on this before we move on. Your business address and phone number on the bank account matter for the same reason. Banks are one of the sources that get cross-referenced, and a residential address on your bank records, while your credit file shows a commercial one, is exactly the kind of small inconsistency that turns into a verification failure nobody explains to you. Now, let me talk about the mistake that does the most damage, and it's the one almost everybody makes at the beginning. Mixing personal and business money in the same account. You know you're not supposed to. Everybody knows that. But it happens gradually, and it happens for practical reasons. You pay for a business subscription with your personal card because that's the card in your wallet. You transfer money to yourself and don't label it. A client pays you through a personal payment app because that's what they had. You buy something for the business at a store and just use whichever card comes out first. None of those feel like a decision. 6 months later, your statements are a mix and you can't fully untangle it. Here's what that costs you, and it's 3 separate things. The first is the legal one, and it's the most serious. The entire point of forming an LLC or a corporation is separating your personal assets from your business liabilities. That separation is a legal construct, and it holds because you maintain it. When you commingle funds, you give anyone suing your business an argument that the entity is not actually separate from you, that it's just you with a certificate. That's called piercing the corporate veil, and if it succeeds, the protection you formed the entity to get is gone. Your personal assets are exposed. This is not a technicality. It's the thing the entity exists to do. The second cost is the funding one, and it's more immediate. An underwriter reading a commingled statement cannot tell what your business actually earns. They see deposits, but some are revenue and some are you moving your own money in. They see withdrawals, but some are expenses and some are groceries. They cannot calculate your real revenue, they cannot calculate your real margins, and they cannot assess your cash position. So they do the safe thing. They discount what they can't verify or they decline. From their side, it isn't personal. They simply cannot underwrite what they cannot read. The third cost is the boring one that hurts every April. You cannot cleanly deduct expenses you cannot cleanly identify. Most owners underdeduct because reconstructing a year of mixed transactions is miserable and they give up partway through. And if you're ever audited, a commingled account is the fastest way to turn a routine review into a long one. So what does clean actually look like? Every dollar the business earns goes into the business account. Every business expense comes out of the business account on a business card or by business transfer. When you pay yourself, it's a single labeled transfer, an owner's draw or a payroll run, going to your personal account, not a series of small withdrawals. One clear, identifiable movement of money that anyone reading the statement can understand. That's it. That's the whole discipline. And here's the part that makes this worth doing properly rather than eventually. Lenders look at 3, 6, or 12 months of statements, which means the cleanup you do today doesn't help you today. It helps you 6 months from now. Every month you delay is a month you have to wait later. If you're planning to apply for anything meaningful in the next year, the account has to be clean starting now, not starting when you're filling out the application. Let me put a number on that. If a lender wants 12 months of statements and your account has been mixed for the last 8, you are not 12 months away from applying. You're 20 months away, 8 to age out the mess, 12 clean ones after that. That's the real cost of putting it off. So what should you actually be looking for in a business bank account? Let me give you the criteria, and then I'll talk about the 2 names people ask me about most. First, and non-negotiable, the account has to be opened in your exact legal business name using your EIN. If a bank wants to open it under your social security number as a sole proprietor when you have an LLC, that's the wrong account. Second, look at whether they report anything to the business credit bureaus. Most banks do not report deposit accounts, so this usually isn't a differentiator, but some products connected to the account do, and it's worth asking rather than assuming. Third, minimum balance requirements and fees. Not because a few dollars matters, but because a monthly fee that overdraws a low account creates exactly the negative days an underwriter counts. Fourth, whether they offer business credit products at all, because a bank that already holds your deposits has visibility into your cash flow and is often an easier approval later than a bank that has never seen you. And fifth, practical things, how you make deposits, whether you handle cash, whether you need physical branches, or you're fully online. Now, the 2 I get asked about constantly are Bluevine and Mercury. Both are legitimate, both are widely used, and neither is a bank in the traditional sense. They're financial technology companies that partner with chartered banks to hold the actual deposits. That matters for one specific reason. Your deposit insurance comes through the partner bank, so it's worth understanding that structure rather than assuming it works exactly like a bank you'd walk into. Bluevine is generally aimed at small businesses that want banking plus access to credit in one place. Mercury is generally aimed at startups and online businesses and is known for a clean interface and being straightforward to open remotely. I'm deliberately not going to quote you rates, fees, or minimum balances because those change and I'm not going to have you make a decision on a number I said in a video 6 months ago. Go to their sites, read the current terms, and compare them against the 5 criteria I just gave you. What I will tell you is what to check, regardless of which one you pick. Confirm the account opens in your exact legal business name, not a shortened version. Confirm the address on file matches what's on your entity filing and your credit file. Confirm you can get statements in a format a lender will accept, and confirm what happens if you need to deposit cash, because for some online first providers, that's genuinely awkward and people don't discover it until they need it. Here's what I'd actually do this week. Pull up your current business account and check 3 things. Is the name on it identical to your articles of organization, including the LLC, including the punctuation? Is the address the same one on your credit file? And can you look at the last 3 months of statements and clearly separate business from personal without guessing? If the answer to any of those is no, that's your project. Not opening more vendor accounts, not chasing a higher score, fixing this because it sits underneath everything else and it takes months to age into something a lender will accept. If you want the full list of what gets verified before anyone looks at how you pay, the entity, the EIN, the address, the phone, the bank account, all 8 items, grab the 8-point Business Fundability Checklist. It's free and the link is in the description. And if this is the first you've heard that your bank statements get read line by line, watch my video on why business credit applications get denied. Most of the reasons have nothing to do with your credit.